For most of this year, market attention has been directed toward equities, technology leadership, and digital assets. Those debates have largely overlooked the asset that produced the most decisive move: silver. This was not a sudden development, and it was not driven by speculation. It followed a structure that has repeated across multiple financial crises over the past 3 decades. To understand what is happening in silver now, it is necessary to step back and examine how silver behaves during periods of systemic stress, how paper contracts influence its price, and how large balance sheets adapt over long-time horizons. Silver and crisis behavior. During the dot-com collapse, the housing market failure, and the COVID liquidity shock, silver followed a similar sequence. In the initial phase of each crisis, silver declined alongside risk assets. This confused many observers and led to the conclusion that silver had failed as a hedge. That conclusion missed the mechanics of the futures market. Silver is heavily traded through leveraged contracts. When liquidity tightens and margin calls spread, silver contracts are sold because they can be sold. These sell-offs reflect forced liquidation, not weakening fundamentals. This pattern repeated every time. The selling phase was driven by leverage, not by silver itself. The transition phase. What followed the liquidation phase is where silver's behavior diverged from most financial assets. As the immediate liquidity stress passed, attention shifted from liquidity to solvency. Physical premiums began to rise, delivery timelines tightened, inventory constraints became visible, open interest remained elevated even as available supply became more difficult to source. The paper market continued to influence price in the short term, but physical realities began to reassert themselves underneath. This transition marked the turning point in each cycle: monetary response and repricing. Each crisis was followed by aggressive monetary intervention. Rates were cut, balance sheets expanded, currency supply increased to stabilize the system. Once policy shifted from containment to accommodation, silver transitioned from a liquidation asset into a monetary hedge. Price did not simply recover, it repriced. This repricing was not emotional or speculative. It reflected the adjustment of a monetary asset within an environment of expanding currency supply and constrained physical availability. The role of paper contracts. Silver's price is largely discovered through paper instruments. Futures contracts, unallocated accounts, and exchange-traded products allow price to be influenced by leverage far in excess of physical supply. This structure can suppress price responsiveness for extended periods, especially when confidence in the financial system remains intact. However, paper dominance does not eliminate physical constraint. It only delays its impact. When demand presses against limited physical supply, the adjustment becomes mechanical rather than narrative-driven. Large balance sheets and incentives. Much has been said about the role of large financial institutions in the silver market, often in exaggerated terms. A more productive approach is to focus on incentives and balance sheet logic. Following the 2008 financial crisis, J.P. Morgan inherited a significant silver derivatives exposure through the acquisition of Bear Stearns. Over the years that followed, market data and warehouse reporting suggested a gradual reduction of net short exposure alongside accumulation of physical silver through custodial and exchange-related mechanisms. This does not require a narrative of manipulation. It reflects rational risk management within a system that allows paper instruments to influence price while physical exposure can be built over time. What matters is not intent, but positioning. When large holders are no longer structurally short, the incentive to cap price weakens. When physical exposure becomes an asset rather than a liability, resistance diminishes. Price is allowed to adjust. Why this cycle is different. Silver spent years consolidating within a defined range. Volatility declined. Structural support held. Positioning occurred quietly. When the move began, it was orderly. Breakouts held. Pullbacks were shallow. Momentum expanded alongside price. This behavior is consistent with constrained supply and firm ownership, not speculative excess. The current cycle differs in scale. The paper market is larger than in prior decades. Physical supply growth is slower. Industrial demand is structurally higher. Monetary expansion remains persistent. Silver did not outperform because it became fashionable. It outperformed because long-running structural forces resolved in its favor. This pattern has repeated across every major financial crisis of the modern era. Initial liquidation driven by leverage. Paper dominance delaying adjustment. Physical constraint asserting itself. Monetary expansion accelerating repricing. The move in silver is not a surprise when viewed through this lens. It is the resolution of a structure that has been building quietly for years. Silver did not chase attention. It waited. And when the system adjusted, it repriced.